Hello, everyone. I'm Jen Kohls of Richardson Capital Management, and I'm joined by Dan Brown, our Director of Investment Management. We're here to provide the economic and investment update for July 2023. Stocks of all types advanced for a fifth straight month, driven by signs that the economy will avoid a recession, falling inflation data, and resilient corporate earnings. We are halfway through the second quarter earnings season. Dan, what are we seeing?
Yeah, results, Jen, are broadly beating expectations. So for top line revenue growth, we're seeing beats of about 1%. And for the bottom line, for the earnings line, we're seeing very strong beats of about 6.5% to 7%. So investors were a little bit too pessimistic coming into earnings season. And as we look at all 11 economic sectors, all 11 are beating expectations. And our take on that is kind of that corporations were prepared very well for the period of higher interest rates, higher inflation, and they took down costs accordingly, with many reducing headcounts.
On the topic of falling inflation data, that's something the Fed is watching closely, along with many investors. The Fed met again in July. Dan, what happened at that meeting?
So we saw the Fed raise again in the month of July. So just going back a month to June, they skipped in June. In July, they raised by another quarter point. So this puts Fed funds interest rate now at a range of 525 to 550. So the highest level of Fed funds in about 22 years. And again, this all the way from the starting point of zero back in March of 2022. So a pretty dramatic increase in Fed funds over the last 15, 16 months. And we also see other central banks around the world also continuing to raise interest rates. And it's all in the name of fighting inflation. So the good news on the inflation front is it is coming down fairly steadily. So investors seem fairly optimistic that the Fed might be near the very tail end of their interest rate hiking campaign.
Despite higher interest rates, economic activity has held up well. Second quarter GDP was released last week and left us pleasantly surprised. Dan, what economic factors are spurring this momentum?
Sure, Jen. So we saw the GDP print come in at about 2.4% annualized. And like earnings, that was quite a bit better than expectations. So expectations for economic growth in the second quarter were about 1.8%. And if we looked at the factors that spurred that growth, the consumer continues to hold up and spend at a pretty decent clip. So that was a nice contributing factor. The nice surprise there in that print was the business investment. So very strong on all the components. And if we look at the overall labor market, it's still very healthy. So it seems to be that the jobs are plentiful, and if workers want to get a job, they can get that job, which again is leading to the strong consumer spending.
It's helpful to understand current events as we look forward. Dan, what is our outlook as we move into August?
So the outlook's improving. As we talked about, second quarter earnings coming in quite a bit better than expectations, as did second quarter GDP. And if we think back to the beginning of the year, a lot of investors were expecting that the U.S. economy could fall into a recession at this point in time. And that hasn't happened. U.S. economy has defied all those expectations in spite of the fact that the Fed has done its historic pace of increasing interest rates. So this somewhat low probability event is playing out of the U.S. economy going through this soft landing. And what that entails is a period of moderating inflation without large job losses. But that appears to be playing out currently.
And with that, we'd like to thank you for watching. If you find our videos useful, please click like and subscribe below. Also, feel free to share the videos with friends and family. We appreciate your continued support.